been foreclosures. And of course, since the housing market drives the economy, when we have problems in the housing market, then of course that pulls down the commercial sector. So if we want to get the commercial sector robust, we've got to get the residential sector moving. And we've had a lot of issues related to delinquent loans and so forth. And the administration has several programs out there to help homeowners refinance their homes so there aren't so many foreclosures. Costs money, costs a lot of money. On the other hand, we've got to ask whether we'd be better off if we had additional millions of foreclosures, or whether we'd be better off if we could get the markets moving. The administration has elected to support the housing market in the foreclosure area. That's good. The bad part of this is it hasn't been done very quickly. And I think they've only implemented about 500,000 foreclosure prevention loans. They had hoped to do 4 million by this point. So there's still some room for improvement. Toxic assets on the balance sheets of the banks, not a lot of money. Those loans in many cases are underwater. At some point, that's got to be recognized and written off. The issue here is if the bank has toxic assets on its balance sheet, it's much less likely to be able to make a loan. And so that's been a major issue. Hopefully we can get the mark-to-market issue resolved where toxic loans are taken off of the balance sheet and still have the banks have sufficient liquidity to make loans, additional loans. Obviously lending has eased up. It could ease up a lot more before it's over, and we hope so. So the economic forecast, well, it's flat, basically flat, up slightly. Almost all economists agree with these numbers, give or take, because nobody knows what the exact number is going to be, but everybody agrees that it's not a barn burner of a recovery, but the recovery is occurring. We don't expect a second dip. We expect things to get better. That's the good news. They're not getting better as fast as we'd all like. That's the not so good news. So taking a look for a minute at South Carolina. As you know, South Carolina has been hit a little worse than the country in terms of impact of the recession. And hopefully we'll start to come out of it about at the rate that the economy generally comes out of it. Because as you can see, South Carolina tends to track the national economy. Under a little right now, but should recover along with the economy. Here again, you can see South Carolina and the nation. Unemployment's been worse here. Unemployment has decreased just like it has in the general United States with housing starts going down. So we're looking for a recovery generally in the country to hit most of the states at about the rate of the national recovery. In the case of the commercial market, as I'm sure you all know, it's way down here in South Carolina. The commercial market is adversely impacted throughout the country. So let's take a look at the commercial market. Now, if you read the papers, here's the scare story. There's $3.5 trillion in commercial debt coming due. Very little of that right now is distress, about $137 billion. However, most of that, all of that $3.5 trillion has to be refinanced. And most of that, or at least a good slug of that, is underwater. And so we get into the question of what we euphemistically call credit market problems. How does it get refinanced? Well, that's just going to have to work its way out where there are businesses that are positive in terms of cash flow or making a profit or whatever, but they're just upside down. Hopefully, there's going to have to be some resolution of that, which hopefully can avoid bankruptcy. And I would think that there will be some programs somehow to help the commercial sector along here, because much of it is just temporarily underwater. And fortunately, much of that $3.5 trillion doesn't have to be refinanced until 2012, 2013. So there's a little bit of time for much of it. But that's the major issue. And the recovery is about a year away. and is strongly dependent on employment. And employment is going to be going up in the next year. It's strongly dependent upon retail sales, and they're going to be going up in the next year. But right now we have a bit of economic uncertainty, and equity capital for the commercial sector is very, very difficult to obtain. Put differently, if you have any cash right now, you're in charge. So looking at office buildings, and I'm talking about the national level, demand's driven by employment. Employment's down, vacancies are up, rent growth is negative. Retail, driven by consumer income. Again, we've got bankruptcies. Industrial, driven by the need for inventory, etc. Another problem. Multifamily, actually that's a sector that's got some positive growth to it right now. Minimal, but positive. So those are the reasons for concern, but we think the economy is going to turn around in the next year, and so that'll alleviate some of that. As you can see, sales in 2008 were substantially down. They're way down in 2009, although that's only the first 8 months. So that's a slowdown. Distressed property has gone up in the last year and a half from $10 billion to $138 billion. And we take polls of our members from time to time, and they all agree with us that it's a slowing down market. Now, the good news is that realtors, by and large, tend, in many cases, to deal with the under $5 million transaction. Most of our commercial membership deals with transactions under $5 million, and those are doing better. It's not great, but they're doing better. Over $5 million, it's slower. So I've got a bunch of these slides that I'm going to go through very, very quickly because they're all the same as this one, namely markets down, vacancies up, absorption's down, and that's the case predicted through about 2010. After that, we do think it will turn up. And same for offices, it's an industrial, it's a slow market. And these slides can be given out to anybody that would like to see them in great detail, but basically they all say that the commercial markets are slow, going to be slow for the next year, with cap rates rising, prices down. And in terms of distressed property, that's where we are. We're at about $138 billion. And hopefully we can work out this refinancing issue and we see a recovery coming that will work its way through without additional problems. Percent of closed sales associated with distress, obviously up because there's more distressed property. Now, there's still a lot of work to be done to resolve this. If you look at the part that says limbo, that just means these are just loans that have not been resolved. A lot of distress there. So, what's the source of funding for the commercial sector? Well, commercial mortgage-backed securities are gone. The government is providing some financing for apartments. The three sources of financing right now are assumed debt, seller-financed acquisition costs, or alternatively, regional and local banks. The regional and local banks have not been hit as badly as have the national banks in terms of their ability to make commercial loans. And for the loans under $5 million, we're told that the regional and local banks are the best bet right now. They are making loans, and that part of the market, the lower end of the market in terms of dollar volume, is actually expected to do a bit better than the overall commercial market. Here's the